Inflation is a term we hear often in discussions about the economy and personal finance, but what exactly is it, and how does it affect our daily lives? In this brief overview, we'll explore the basics of inflation, its causes, and its impact. What is inflation? Inflation refers to the rate at which the general level of prices for goods and services rises, leading to a decrease in the purchasing power of money. Simply put, as inflation increases, each unit of currency buys fewer goods and services. This is why things seem to cost more over time. Causes of inflation. Inflation can be driven by several factors, primarily falling into three categories. Demand pull inflation. This occurs when demand for goods and services exceeds their supply. It's often summarized as too much money chasing too few goods. This type of inflation typically happens in a growing economy where consumer spending is high. Cost push inflation. This type arises when the costs of production increase, leading producers to raise prices to maintain their profit margins. Common causes include rising prices for raw materials and increased wages. Built-in inflation, also known as wage price inflation, this occurs when workers demand higher wages to keep up with rising living costs. Employers then pass on these higher labor costs to consumers in the form of higher prices, creating a cycle of rising costs and wages. Measuring inflation. Economists measure inflation using indexes that track price changes over time. The most commonly used is the Consumer Price Index, CPI, which measures the average change in prices paid by consumers for a basket of goods and services. Another important measure is the Producer Price Index, PPI, which tracks the prices received by producers for their goods and services. Effects of inflation. Inflation impacts various aspects of the economy and personal finance. Erosion of purchasing power. As prices rise, the same amount of money buys fewer goods and services. This can significantly affect those on fixed incomes, such as retirees. Impact on savings and investments. Inflation can erode the real value of savings if the interest rates on savings accounts and investments do not keep pace with inflation. Effects on borrowing and lending. For borrowers, inflation can be beneficial if they have fixed-rate loans, as the real value of their debt decreases over time. For lenders, inflation can erode the real returns on loans if interest rates are not adjusted for inflation. Conclusion. Understanding inflation is crucial for managing personal finances and making informed economic decisions. By recognizing its causes and effects, you can better prepare for its impact and take steps to protect your purchasing power. Whether you're saving, investing, or simply budgeting for everyday expenses, keeping an eye on inflation trends is key to maintaining your financial health.